Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, our weekly look at the world of business and finance. This week, back to Dubai. The Emirate claims to be on the comeback trail from last year's disasters. But there's two sides to this desert fairy tale. We'll bring you both of them. Also, we go to the Paris Motor Show. The boss of General Motors Europe speaks to Counting the Cost about the state of the car industry. And the power to transform. $1 trillion of mineral wealth just waiting to be dug out the ground, but who'll be brave enough to come to Afghanistan? We are back. The words of Dubai's ruler, Sheikh Mohammed bin Rashid Al Maktoum this week, which is a big old claim to make in a place that got hit by the economic downturn so spectacularly. Almost a year now since the $100 billion debt of Dubai's flagship company, Dubai World, brought the Emirate undone. In short, it suddenly said, sorry, can't pay the debt. But just last month, there was an agreement to restructure about $25 billion of that debt. And now, in the first debt sale since the crisis, there's enough orders to raise 5 times the $1.25 billion Dubai was looking for. A big turnaround? Maybe. If you look at other important indicators like property, though, it's a very, very different story, and one echoed elsewhere in the Gulf. We'll look at Dubai in depth right after we explore our own backyard, Doha, from where we bring you this show each week, of course, and depending on who you believe, a self-sustaining Gulf success story or just another Dubai waiting to happen. Emike Umolu has this report.
The lure of Dubai's iconic palm development replicated across the peninsula in Doha. The Pearl is the Gulf's new playground for the well-off and comes with all this on your doorstep. And if you have the cash, you can even add mooring space for a yacht. Newlyweds Amin and Rasha bought a $400,000 apartment here in the midst of the global downturn. They're convinced it will pay dividends.
It is worth it, believe me, it is worth it. People who invested before in this project, who believed in the project from the beginning, did good money. Some people did double their money. So I believe on long term, I will do the same. It will be double.
Rasha, who also works for one of the site's developers, admits getting buyers on board hasn't been easy, but says even so, many flats have been sold and she wanted a slice.
When we saw the finishing, we saw the services, we said, no, we should benefit from this.
While the Pearl may be popular, it's fast becoming an exception to the rule. The job migrants that help to spur this oil-rich economy are no longer flocking here at the rate they used to. This means demands for homes is waning, though construction continues at breakneck speed. With so much being built, rent has been pushed down 11% in the last year, as landlords settle for less cash, desperate to fill their empty homes. Many commercial towers are also sitting vacant. Smaller firms in villas like these are now under pressure to move into these new towers. Property consultant Mark Proudly says it's just one of several measures by the government to prop up the market.
The government ministries have leased a number of the commercial towers and that has soaked up quite a large amount of the vacancy rate. But vacancy rates are still running at sort of 20 to 25% amongst commercial stock.
Dia Nufal, who spent years tracking property prices here, says despite the problems, Doha will not become another Dubai.
That's a different story, and I think Qatar is learning from Dubai lessons. And I think they're doing fine, and they have their limits. They didn't go over limits so far.
They might not have reached their limit, but they could be close to it. State-backed conglomerate Bauer Real Estate recently halted some of its projects across the country until the market improves. That's after having some of its debts written off. Another sign of the government lending a helping hand.
Right, so you see they're a very cautious property market in Doha, but these numbers we're going to bring up just now will put it into some sort of perspective. Here's Doha. Nearly 200,000 square metres of office space will come onto the market this year, adding to the already 15 to 20% of properties which are empty right now. Now check out Dubai, over 1.7 million square metres of office space to be added, which could push vacancy rates from 38% where they are now to more than 50%. To put that in perspective, London, the largest and most established office market in Europe, the Middle East and Africa combined, it only had 16% office vacancies at its worst back in 1992. So the truth is, Dubai is not necessarily back, as its leadership has said. Indeed, there's a lot of empty buildings which say otherwise. And some of those numbers you just saw there came from Jones Lang LaSalle, the real estate advisory company. And Graham Coots is with us now from JLL in Dubai. Graham, thank you for your time. These numbers are quite staggering, I think. When did supply in Dubai start outstripping the demand to such an extent? I mean, I've always looked and thought, well, looks like they're building too much, but these numbers, they really tell the story.
Well, I think you've got to put this in the context of the growth that Dubai was experiencing throughout the early part of the 2000s, right up to 2007, 2008. And at that time, there was a tremendous shortage of office space. I think most businesses found it very difficult to get space. Rents were rising very rapidly, and many companies were having to forced to have space in a number of different buildings in different locations. And I think against that, we also saw the master developers establishing plans for the development of Dubai, and it really wasn't until 2009 that the supply pipeline really started to deliver in large volumes, and the large amounts of space that we're now seeing started to come to completion.
So you don't think then that Dubai just misread the demand completely, or the projections completely? As I said, anecdotally, you just look at Dubai, the sheer number of buildings, and you see it here in Doha too. You just look around and wonder, how can all this be filled? And why was it all built in the first place?
Well, I think clearly that Dubai has more space than it needs currently, and there is a lot more coming through in the pipeline. But I think in terms of misreading the signals, I wouldn't say it was so much that. I think it was the fact that in the early part of the 2000s, there wasn't really any clear information as to the total amount of space that was being built. So developers really couldn't get a much of a picture on the overall situation. They may know what was going on in their immediate area, but they didn't know what was going on in other parts of the emirate. And I think really that lack of any sort of central register of all developments and all development activity, coupled with a relatively lax planning regime in the sense of it didn't attempt to control development to specific areas, really encouraged it. And then at the same time, we had through the early part of the 2000s fairly liberal credit policies. So funding wasn't an issue for the developers. The economies were booming, and the supply was was short supply, and I think those factors all really conspired. Obviously, with hindsight, it's very easy to see now that the delivery of the large amount of space that's come on, I think we've seen a doubling in the amount of office stock over the last 2 years, has been well ahead of the amount of demand that could fill it up.
What about the Dubai world factor? You mentioned 2009 being sort of a turning point, and certainly towards the end of 2009, the whole Dubai world debt crisis shocked everyone. It created a confidence crisis in Dubai. Was that a catalyst as well, do you think?
Well, I don't think that was really a cause. That was an effect, perhaps, but that was more of an effect of the external global environment and the tightening of credit. I think the oversupply situation certainly would have happened. The high levels of vacancies would have happened anyway. But I think the other side of the coin is that with large amounts of increasingly lower cost space, Dubai is starting to fill up again. And over the last year and a half, 2 years, we've seen quite a big increase in the amount of occupied space. And in fact, on a world scale, Dubai probably ranks up there amongst the cities which have seen the biggest growth in the amount of occupied office space of any of the major cities in the world.
Okay, so here's the $64 million question, or $1 billion maybe. What do you do? What do you do with all these empty buildings? Do you wait it out, or do you take some sort of action? Your report mentions the idea of demolitions. I don't know if you're advocating that, but what do? Do you just mothball the buildings, wait it out?
Well, we're certainly not advocating demolition of brand new buildings. I think what we did see with other cities that faced high levels of supply, and in fact, Shanghai in the late 1990s experienced vacancy levels higher than we're currently encountering in Dubai. But the cities like Shanghai, like Moscow, like Singapore, which all went through a boom period and an overbuilding period, we saw a period when there was actually very little development, and in fact, the amount of space diminished. Not because people were necessarily knocking over buildings, but because buildings were being withdrawn either secondary buildings were being refurbished to make them more competitive, or alternative uses were being explored. And I think that's one of the things that we do need to look at in Dubai, is what are the uses for some of these, perhaps the less well-located buildings, the buildings that are perhaps not to the international standard that tenants are increasingly seeking. What are the uses that they could be put to? We're seeing schools looking at office space now. We're seeing universities looking at the opportunities to take office buildings. Who knows? We may even need to look at affordable housing some of these buildings in the short to medium term.
Graham Coots there, thank you so much for your time. Let's turn our attention now from Middle East property to the more traditional market of Middle East oil. And Royal Dutch Shell is coming under all sorts of pressure over its activities in Iran. As you probably know, doing business with the Islamic Republic is a political minefield, and while other major oil firms have been scaling back their dealings with Iran, Shell is apparently doing the opposite. Nazanin Mashiri takes up that story.
Iran holds some of the largest oil and gas reserves in the world, reserves the country relies on to fund its economy. But harsh sanctions on oil investment, shipping and insurance have made life very difficult for the Islamic Republic. While the international community continues its tough stance, a report in a British newspaper shows major oil players like Shell are actually increasing their trade with Iran, stepping up orders of crude. Shell says it's doing nothing illegal, but what's contentious is the company may be taking financial advantage of the sanctions. Although Shell insists it didn't buy the crude at a discount, one source close to Iran's oil industry has told me that the international clampdown has led to a vast backlog of crude reserves over the summer, and that the Islamic Republic would have offered oil giants like Shell a good deal. Some experts argue the world economy needs Iran's crude exports.
If Shell and other companies are buying Iranian crude oil, they are keeping the price of oil within a certain limit. Can you imagine if the world doesn't buy 2.5 million barrels of Iranian exports? What will happen to the price of oil?
All of this brings into question whether international sanctions against Iran are actually working. The reality is that Iran is a global energy giant, and companies like Shell will continue to engage economically with the country.
When Counting the Cost returns, we hit the road. The Paris Motor Show has been in full swing. We'll speak to one of the world's biggest automotive players as the industry tries to fight back. Welcome back to Counting the Cost, your weekly business stop right here on Al Jazeera. It has the ability to transform a nation that has been torn apart by conflict. We've actually looked at this before on Counting the Cost. The untapped mineral deposits in Afghanistan, estimated to be worth about $1 trillion, which could last for generations. This report from Sue Turton, who has now been to the area, with the potential to change Afghanistan.
In the archives of Afghanistan's geological department, the country's wealth mapped out by the Russians many years ago. Decades of war meant these minerals stayed out of reach, but now the Afghan government wants to show that the country is stable enough to invest in and safe from the corruption that dogged its first mining contract with the Chinese. With some military assistance, the mining minister flew us up to the mountains of Hajigak iron deposits west of Kabul, where the mining contract went up for tender this week.
How can you ensure, in such a climate where corruption is mentioned almost on a daily basis, that this is not going to be the problem here?
The thing is that we have developed a very well public communication strategy for this Hajigak iron ore deposit tendering process, to make sure that all the relevant stakeholders, from the government to the parliament to the Afghan civil society, as well as our international organization partners, they will have access to all the relevant information right from the beginning.
The biggest challenge for the Afghan government is to ensure that the profits from mining these huge mineral reserves doesn't just go to the foreign company that wins the contract. With corruption marring the first $1 million deal done with the Chinese for copper, local people here are watching very carefully to see who will profit from mining these huge iron ore deposits.
Villagers came up to greet the ministerial party visiting their mountain. Mohammed Sadiq's family had lived here for 2 centuries. He said he welcomed the mine as long as he got a job in it. The potential revenue from the estimated 2 billion tonnes of high-grade iron ore in this one area alone could have a huge impact on the whole country's GDP.
This will last for 180 years if you mine 10 million tonnes a year. But 20 million tonnes per year, that will last 90 years, for generations to come. And it will provide steady income to the government of Afghanistan.
But with 2 years of further exploration before mining can begin, this requires long-term investment, and that means faith in the stability of the region.
In certain areas in the north, for example, and in central Afghanistan, even as we speak, security is such that they can go to those areas. But unfortunately, the infrastructure that has to be created for those kinds of exploration, the roads, go through insecure areas. So we have to balance the issue of security and issue of investment. They have a direct relation.
But security fears didn't dissuade over 100 potential investors and executives from talking to the mining minister in New York about the Hajigak iron contract earlier this week.
All right, destination Paris now, and the motor show rolled into town this week. This year's show, lots of new cars on display, of course, but all told, it's really the story of an industry still trying to find its feet post the worst recession in decades. Perfect example, General Motors went bankrupt, of course, but then its other divisions like Europe have been through all sorts of upheaval in the last year as well. Europe became a real political football in Germany where jobs are on the line. The business was then going to be sold to a Canadian consortium, then it was pulled back by GM, which decided it was an important brand after all. So there was all sorts of stuff going on. Let's go now to the Paris Motor Show. Welcome back to Counting the Cost, Nick Riley, the president of General Motors in Europe. Nick, thank you for your time. I think it was March, Geneva Car Show I last spoke to you.
Yes.
Yeah, right, and things were cautiously optimistic then. What's it like now being the boss of a major car company compared with when we last spoke, or indeed a year ago?
I think it's a lot better now. I think we've seen the dip, the bottom of the market in Europe in particular. I don't think it's going to jump back very sharply, but I'm not a proponent of the double dip. I think we've seen the bottom and it's going to gradually return. So I think you'll probably find the atmosphere in Paris a lot better than when I last spoke to you.
What makes you so confident, though, about having seen the bottom? I mean, anything specific?
Yeah, there are several markets that are showing some strength, and we have gone through a period where there were a lot of scrappage schemes in several countries in Europe. That brought forward some volume, so we had a dip. I think we're through that dip now, and most of the effect of the scrappage schemes has gone, so you're seeing a return to normal sort of demand, and we're seeing that regularly across most countries in Europe. However, it's not at the levels we saw in 2007 and 2008, and I don't expect it to get back there for quite a long time.
In hindsight, and I suspect I asked you this last time, but I still think it's relevant actually, were the scrappage schemes the right idea? Money in return for trading up from an old gas guzzler. Did it save the industry at its low point, or has it provided a sort of uneven blip when you look back at it now?
I think the scrappage schemes were probably appropriate. The industry would have gone down to really low levels, and it's not just the car manufacturers, but it's the suppliers and the dealers and everything else. So I think the incentives were probably appropriate. We certainly liked it at the time. You always have a bit of payback after that, but the economies are generally a little stronger now, so we can take it better than we would have been able to in 2009.
All right, then let's talk about your cars, shall we? The one behind you, I think it's a petrol one, but what about the electric cars or the hybrids? Because I think most people agree now electric cars are the future, and that this is a time when investment really has to go into your electrics and your hybrid cars.
I agree. I'm actually very bullish on electric vehicles. Some people are skeptical and say they're too expensive and people won't pay that sort of money. I don't agree with that. I think governments around the world are going to incentivize them. If you go to Asia and step out of Europe a bit, you'll see there's billions of euros being invested in this technology for their own domestic market, and they'll learn quickly, and if we don't, then they'll come and take the European markets. So GM and Opel specifically in Europe, we're working hard on several different electric vehicles, and we will have the first extended range electric vehicle on the market at the end of next year, what we call our Ampera. That drives electrically most of the time, but if you want to go on a long journey, you can do, and it takes the range anxiety away. But we're also working on several other electric vehicles.
You know, I used that as sort of a cliched phrase, Nick, that electric cars are the future. Do you think, though, in the future, and maybe we're looking, you know, a long time down the line here, where electric will be the only way forward? You know, think of televisions. Most companies, they gave up on making the big boxy tube televisions. They instead decided, right, flat screen, plasma, LED, whatever you want to call it, that is the way forward. Will there be a moment where we say the fuel car is gone, electric all the way?
I think that is possible, but it's a long way away. The reason is the development time for new cars is quite long, 4 or 5 years from really the instigation of a new idea to a car being on the road. And in the case of electric vehicles, the technology is still developing, and so the cost is high, the volumes are fairly low, so we've got to see that Generation 2, Generation 3 come through. But once they become competitive in cost, I think there'll be a very rapid switch to electric vehicles. And so yes, I can see what you described, but it's many years away. And then, even if you have a very high percentage of new cars being electric vehicles, you've got the whole park of cars that are still out there that are going to be there for many, many years to come. So your vision is probably right, but it's a long way away.
Nice to know I've had a good vision then, though. Nick Riley there from General Motors. Thank you very much. A couple of bits of technology news for you now, always a favourite topic of ours. The maker of the BlackBerry smartphone, Research in Motion, has showed off its latest gadget, a new tablet computer.
It's the ideal form factor.
Strangely, for a business-oriented company like RAM, they've gone for the name Playbook. They say it's targeted at business customers, therefore isn't just a pop at Apple's iPad market. But it isn't hard to see why it's being launched now. The Playbook has a 7-inch screen. Rival Samsung has pitched its tablet computer too, which is powered by Google's Android system, with a similar size screen. That compares to the iPad's 10-inch screen, so according to its rival's, size doesn't matter. Also one for the gamers out there, Nintendo's much-anticipated 3D handheld games player won't be released for the crucial Christmas holiday season. That sent the company's stock tanking, along with news there was a lack of new games for its existing games console. And not forgetting, because of course we keep telling you about this for the last few weeks, the strong yen is really crimping profits at the Japanese company. Still, when it does arrive, it'll provide the 3D experience without the silly glasses, so that's got to be a plus too. Just about it for this week, but don't forget to check us out online. The business link at aljazeera.net/English will lead you to the Counting the Cost page. Previous episodes of the show, this episode too, weekly blogs to go with them all. And of course our Twitter page growing by the week, which is always good to see. At AJ Counting Cost is where you can get in touch with me or send in your ideas. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. See you next time.